right, greetings everybody. Here we are again. Hope the test went well. Everybody should have taken that test by now over chapters 8, 9, and the first part of 10. So what we're going to do now, we have no homework to go over, obviously. So what we're going to do is the majority of today will be lecture, since there's no homework to go over. But we're going to continue on into chapter 10 on fixed assets. And we're getting towards the end of it, aren't we? We have the rest of chapter 10, and then we have chapter 11, and then we're done. Except for you have to take your comprehensive final, right? And chapter 11 goes really pretty quickly. Chapter 11 is a lot of stuff that we've already talked about before. It's on current liabilities, but there's a lot of issues in there that we really have touched upon. Or they are simply the flip side of the accounts receivable stuff that we have done. So chapter 11 will move pretty quickly. So we really don't have a whole lot left, okay? But let's continue on with chapter 10. And I'm going to direct you in your PowerPoints. Why don't you go ahead and turn to it. I want to cover something that we have not covered before, okay? Pardon me? This isn't in there? Look in chapter 10. Are you looking at chapter 10?
It's in there. Oh, okay.
Hey, never question me, okay? Never, ever question me in front of the students. I'm just kidding you, okay? Everybody find this? This was in the section that we went through, but I kind of skipped this if we don't have time, and we didn't have time, okay, to cover it for the last test. So what I want to talk about is lump sum purchases. This is the sort of situation where, let's say you pay a certain amount of money, and you get like 3 large fixed assets with it. Okay, like in the example we're going to go through in a minute, you pay $200,000 cash, and you get land and a building, but they don't really designate how much you spent on each, because a lot of times the building is on the land. Does that make sense? And really, when you purchase a home, this is kind of what you're doing, isn't it? Because you actually get the land that the home is on as well, don't you? Okay, but they don't really designate, well, this is how much you paid for the land, this is how much you paid for the building. Okay, so how do we do that? Okay, well, let's take a look at a couple ways that you can't do it. Okay, looking at the Elmo, if you pay $200,000 for land and a building, let's say you paid cash. Well, we know the credit is to cash. You can't do this. You can't set up one asset, land/building, for $200,000. Why can you not do that? What's one reason you can't do that? Oh, good job, Kristen. Land isn't depreciable. Buildings are depreciable, right? So going back to the Elmo, you can't do it that way. Now, somebody might say, well, why don't you just debit land for $100,000 and building for $100,000, credit cash for $200,000? Well, all you did was make some sort of artificial division, but that's really not based on anything, is it? Okay, so you can't just say, well, let's just do half for each. So how do we do this? Well, let's take a look. It's not really that hard. What you're going to do in looking at the PowerPoints is, and this is going to be best illustrated with doing an example, okay? What you're going to do is you're going to separate them, you're going to allocate them based on their relative market values. Let's look at an example. On January 1, Matrix purchased land and building for $200,000 cash. The appraised values are building $162,500 and land $87,500. Okay? How much of the $200,000 purchase price will be charged to the building and land accounts? Okay, going back to the Elmo one more time. Here's another thing that you cannot do. What did it say that they were appraised at? $162,500 for the building and $87,500 for the land? You do not. Was this how much was that? 162? You do not record those at that cost. First of all, you only paid cash of $200,000, right? But this is a violation, and then somebody might try to record like a gain or something. No, no, no. You can't record those at that amount. That's not the amount that you paid for them. If you did that, that would be a violation of the cost principle. Okay? So how are we going to do this? Well, I'll show you. You are going to use those appraised values to allocate that purchase price of $200,000. Okay? The appraised value of the land was $87,500. The appraised value of the building was $162,500. Now what you do is the total of those is $250,000. Let me get my pointer going. The total of those is $250,000. Then you're going to divide that by $250,000, and that equals 35. $162,500 divided by $250,000 is 65%. These were pretty clean numbers. They're not always going to be clean. You can round as long as you round so that that equals 100%, right? Because then what are we going to take those new percentages times? We're going to take those times the purchase price of $200,000, and that will give us the apportioned cost. Okay? Now again, you can round over here, but that has to equal $200,000, or else your journal entry is not going to balance, right? So when you recorded that journal entry, you would debit land for $70,000, you would debit building for $130,000, credit cash for $200,000. And of course, as you said, Kristen, you would depreciate that building, but not the land. Make sense? Okay, not too hard, is it? We'll have one of those to do in the homework. Okay, questions on that? Okay, if not, we talked about depreciation. And I want to jump to, we talked about the, let's go ahead and just go to this slide right here as kind of a refresher. On the straight line depreciation, you depreciate the same amount every year if it's purchased at the beginning of the year. The units of production is right up here, and it will change how much you depreciate each year because it's based on what your actual production was. And then this was the double declining balance method, okay? And you depreciate more in the early years and then less as the years go on, okay? One question I noticed that people missed a lot on the test, and this is a common error, is I asked what is depreciation, and one of the options was depreciation measures the decline in market value. Okay? No. Depreciation, we do not depreciate to try to match what the market value of the asset is, because one person's viewpoint on what the market value is going to be completely different from other people's. Depreciation is simply a spreading out of the expense, an allocation of the expense over an estimated number of accounting periods. Make sense? We're not trying to match market value. Okay? All right. We don't talk a lot about taxes in this course, thankfully, but I want you to at least be familiar with this term. There's something called MACRS, Modified Accelerated Cost Recovery System, that allows you to depreciate your assets quicker or more rapidly. Okay? Now, why would you want to do that? Why would it be beneficial to write your assets off or depreciate them faster?
A loss. So you can write off more.
Okay. And why would you want to do that?
Pay less taxes.
There you go. Okay. Now, understand when you're doing your tax return, you want to get that net income legally as low as you can, because that's what you're going to have to pay your taxes on, correct? If you're a corporation, right? So, understand that companies wish, well, let's put an example. Let's say you buy a $60,000 bulldozer or something. You would love to be able to expense that entire $60,000 bulldozer in the year you got it. so you could get the tax savings right away because your net income would be lower if you could expense that $60,000, right? We would rather be able to do that than have to spread it out, right? Well, the maker system allows it to us to more rapidly write it off. And actually, like I said, we're not going to get a lot into taxes, but the way you depreciate on your books versus the way you depreciate on your taxes actually does not have to be the same, okay? But if you get to take a tax class, if you're so fortunate in your educational career, you'll discuss that stuff a lot more. I remember my tax class. Does anybody here have to take taxes? Okay. All right. Okay, let's cover a couple quick topics. Now, in all of the examples that we did as far as depreciation, it seemed like we always bought the asset at the very beginning of January, and thus we had it for a full year that first year. Okay? Well, obviously in real life, you're not buying everything that first week of January. Okay? There's what we call partial year depreciation. And what all that means is if you buy your plant asset during the year, you just figure out the fraction of the year that that asset is owned and take that into account. For example, let's say we purchased some equipment on June the 30th of 2007. The equipment cost $75,000, has a useful life of 10 years, and an estimated salvage value of $5,000. Now, $75,000 minus $5,000 is $70,000 divided by 10 years means that we would take $7,000 a year in depreciation for a full year, right? However, that first year, how many months did we have it? 6. We had it for 6. Okay? So we would only depreciate $3,500 of that for the first year. And of course, that last year would be the same. Make sense? I think that's kind of common sense. I kind of wish they wouldn't have used June 30th. Let's say we purchased it on September 30th. Let's say we would have purchased that equipment on September 30th. What would this fraction be here then? 3/12. It would be 3/12, right? Because you bought it at the end of September, thus you had it for October, November, December. 3 months, right? And you can just round to the nearest month. You don't have to figure out the exact amount of days that you had it, okay? All right. What about changes in estimates for depreciation? As I've said before, a lot of times people think accounting is totally based on known amounts. Well, that's not true. There's a lot of estimates that we have to make. For instance, in depreciation, we estimate the salvage value, right? We also estimate the useful life. Now, there's guidelines in making those estimates, but there is some wiggle room there, right? What happens if we're depreciating an asset and we find out new information that indicates the original estimates weren't as accurate as they should have been? How do we handle that? Well, let's look at an example. You can look in your book as well. On January 1 of 2004, equipment was purchased that cost $30,000, has a useful life of 10 years, and 0 salvage value. During 2007, the useful life was revised to 8 years total. Now, that means that there's 5 years remaining because we've depreciated 3 years. Calculate depreciation expense for the year ended December 31, 2007 using the straight line method. Okay? Well, the formula that we're going to use is we are going to use the book value at the date of change minus the new salvage value, if we have a new estimate, divided by the remaining useful life. Okay? Do you remember what book value is? What is book value? It's one of those things that, I don't know why, but students always seem to forget what book value of an asset is.
Market value?
No, it's not market value. It's the cost minus the accumulated depreciation is book value. Book value of an asset equals the cost, the original cost of the asset, minus whatever you've depreciated in total so far. Okay? All right, so in this example, the asset had $30,000 cost, 0 salvage value, useful life of 10 years. Okay, so 30,000 minus 0 divided by, we were depreciating $3,000 per year, is that correct? In 04, 05, and 06, we depreciated $3,000 each of those years, correct? You with me? So what is our accumulated depreciation at the beginning of 07? We've depreciated 3 years, 9,000. We've depreciated 9,000 at the beginning of 07, right? You with me? So what is our book value at the beginning of 07? It would be the cost of 30,000 minus whatever we depreciated so far. And in this case, that would be 9,000, and the book value would thus be what? 21,000. Okay? And there it kind of talks about. Okay? We depreciated $3,000 per year for 3 years. We depreciated, 04, 05, and 06. Now we're at the beginning of 07. We've depreciated a total of 9,000. So now we subtract that, and we have a book value at 21 grand. What's the remaining life? They revised it to a total of 8 years. We've depreciated 3 years, thus we have 5 years. Thus, 21,000 divided by 5, because there's still a 0 salvage value. That means we are going to depreciate $4,200 per year for the remaining 5 years. We're not going to go back to previous years and change how much we depreciated. We're not going to revise prior year financial statements. We're simply going to depreciate $4,200 a year from here on out. Cool? All right? And, with all these things, I hope you're looking at your textbook, especially when needed, as far as, looking at what they have to say about this and the examples that they give. Okay? All right. Just another quick little item as far as fixed assets. This is a partial balance sheet. And this is how fixed assets often look on the balance sheet. You list your cost of all your different fixed assets, and then you just subtract your total accumulated depreciation from your total fixed assets, as opposed to having accumulated depreciation subtracted from each one of these items. Does this make sense? A lot of times you'll do it like this, where you just put all of your accumulated depreciation in one total and subtract that from the cost, and then that gives you your net property, plant, equipment, or you could say your book value.
So you total on your T accounts?
Yeah, you would just total up, and you'd probably have a number of different accumulated depreciation accounts, but you would just total those up and put the total in the balance sheet. Okay, what about additional expenditures? Let's come off the PowerPoints for a second. As you have a fixed asset, like let's say you have that bulldozer that we talked about earlier, there's going to be expenditures during the life of your fixed asset, right? Anybody who has a car knows this, right? There's maintenance you have to do. Sometimes you have to get it fixed. How do we account for those additional expenditures? Okay. Well, it makes a big difference. For instance, on that bulldozer, if you go get an oil change, we're going to account for that differently than, let's say your transmission goes bad and you have to get a whole new transmission. Okay? And that's what this section is talking about, is how do we account for those additional expenditures. Now, I think the way that these slides kind of talk about this is actually a little needlessly confusing. Okay? Especially the slide that is up there right there. So let's actually go. Let's go to this slide right here. There's mainly two types of expenditures. There's those that are called ordinary repairs. These are the things like getting an oil change, okay, or getting a tune-up. When you buy a car, for example, you know that you're going to have to get oil changes for it, right? You know you're going to have to get tuned up every now and then, okay? Those things just simply maintain the normal operating condition. They don't increase the productivity. They do not extend the life beyond the original estimate. When you made that original estimate of life, you were assuming with your vehicle that you would get oil changes, right? Okay? So this is called a revenue expenditure. And what we do when we have those types of expenditures is we just expense them. Okay? So let's say you spent $50 on an oil change for your delivery van. You would just simply debit like maintenance expense and then credit cash for $50. Okay? Make sense? Now, what if it is something that is a major overhaul or even maybe a partial replacement? For instance, let's say you have a delivery van and let's say the engine goes bad and you have to put an entirely new engine block in your van. I had to do that with a car once. Okay? Well, that's probably something that's a little bit out of the ordinary, isn't it? And the key with that is it's going to extend the life of that van probably beyond the original estimate. Okay? We call that a betterment or an extraordinary repair, and that is a capital expenditure. What does that mean? That means we capitalize that expenditure. When I say we capitalize an expenditure, what I'm saying is we do not debit an expense account, but we debit a fixed asset. And then that amount of fixed asset needs to be depreciated. Does this make sense? So you have to ask yourself, is this an ordinary repair? You know, something that it doesn't increase the productivity, it doesn't extend the life, it's just something we have to do, versus whether this is like a major overhaul or partial replacement. Okay? Revenue expenditures, capital expenditures. Okay? Now, with either of these, if it's a very small amount, you're going to always expense it. Okay? You're going to always expense it. Coming off the PowerPoints, this brings you to, and I don't know if your book talks about this, but kind of a real life sort of knowledge thing, is most companies have what's called a capitalization policy. A capitalization policy. And a capitalization policy is a policy that a company has in place, and if an expenditure is below that, they just expense it. They're not going to capitalize it, even if the asset that they buy will last a number of years. For an example, let's say you have a capitalization policy of $200, okay? And let's say that I buy a table like the ones you're sitting at. Let's say I pay $55 for this table. Now, do you think this table is going to last longer than 1 year? Sure it is. But we're not going to depreciate, $5 or whatever a year for 10 years. Okay? What we would do is, if the capitalization policy is $200, $55 is less than $200, boom, expense it. Just put it in expense. Okay? I actually went to one of my clients once that didn't have any sort of capitalization policy, and they literally had like things on their fixed asset schedules like a folding chair, and they were depreciating, $1.27 a year.
That's what working needs to do.
Okay, and that's like, well, that's just work you don't want to do. That's just too many journal entries. Okay, so a capitalization policy is just a certain amount that if it's less than that, you just expense it. You don't ask anything. Okay, you with me? All right. I don't think any of these things that we're talking about are real difficult. It's kind of a potpourri of things in this subject. Now, this next topic, though, is a little bit more involved. And that is, what about at the end of an asset's life when we dispose of a plant asset? When we dispose of a plant asset, that means we're not going to have that asset anymore. We might sell it. We might donate it to charity. We might just take it to the dumpster and throw it away, right? But no matter what the asset is, someday it will be worthless, won't it? Okay? All right? Or we will need a new one, we'll sell it or whatever, okay? All right. There are 5 steps in disposing of plant assets. And when you dispose of the plant asset, we're going to be kind of creating the journal entry or building the journal entry as we go along. And I want you to follow these 5 steps. The steps are, first of all, when you're going to dispose of an asset, the first thing that you need to do is update depreciation up to the disposal date. Okay? That usually will involve some sort of partial year depreciation. But let's say at the end of June, we're going to junk an asset that we've had. We'll go ahead and depreciate those 6 months from January to June and record that journal entry. That's the first thing you need to do if it hasn't been done already. Make sense? First step is update depreciation to the disposal date. Now the next 4 steps, steps 2, 3, 4, and 5, involve building the journal entry that will go on your books to dispose that fixed asset. The first thing you want to do is you want to remove the plant asset from the books. Now plant assets have a cost, it's a debit balance, so you're going to be crediting something, right? Okay? And we'll do an example here. The second thing you're going to do is remove the accumulated depreciation from the books. What type of account is accumulated depreciation? Contra asset with a debit or credit balance? Credit. So to take it off the books, what do you have to do? You have to debit it. That's the third step. The fourth step is you're going to record any asset given or received. Okay? For instance, let's say you sell your van for $500. Well, then you would debit cash for $500, right? Make sense? Okay? There could even be times that you had to pay to get rid of an asset, right? You had to pay to get rid of an asset. For instance, there's sometimes, like if you're going to get rid of an expensive computer system or something, you're not really just supposed to throw those in the dumpster, are you? Let's say you had to pay a service to recycle that and to zero out all the memory and stuff. Well, then that would be an asset given. Okay? But the fourth step in looking back at the PowerPoint is to record any asset given or received. Usually that's going to be cash. And then the fifth and final step is make that journal entry balance. If it doesn't balance and it's light on the credit side, then you're going to record a gain on disposal. If the asset is light on the debit side, you're going to record a loss. Okay? Have we talked about gains and losses before? A little bit. As a refresher, a gain account has a credit balance kind of like a revenue, and a gain is shown on the income statement. A loss account has a debit balance kind of like an expense. It is also shown on the income statement. Okay? Let's take a look. All right. On December 30 of 2007, Evans Company sells a machine that originally cost $100,000, and they sold it for $60,000. The machine was placed in service on January 1 of 2004. It was depreciated using the straight line method and has an estimated salvage value of $20,000 and had a useful life of 10 years. Okay? All right, we're going to account for this thing. Let me turn to it in my example. Okay? All right. Now, you might want to keep your PowerPoints in front of you as we work on this, but I'm going to do it by hand as opposed to going through the PowerPoints, okay? All right. So, in going to the Elmo, we purchased this thing on January 1 of 2004, right? Let's go back to January 1 of 2004. What was the cost of this thing? It was $100,000. And what was the original salvage value? Well, what is it? $20,000? And what was the estimated life? 10 years. Thus, how much did we depreciate it in a full year? $8,000, right? Okay. All right. Well, thus in 2004 we depreciated $8,000, right? In 2005 we depreciated $8,000. In 2006 we depreciated $8,000, right? Now, what is the first step in disposing of an asset? You're going to update the depreciation. Now, we're selling it on September 30 of 2007, correct? So how many months of 2007 do we have to depreciate? 9. What's 9/12 times 8,000? 6,000, right? So the first thing that you want to do is you're going to actually record a journal entry for 6,000. Okay? And thus in 2007, we now have depreciation of 6,000. Is that correct? And that's the result of doing this entry. That's the first step. You with me? So, by the way, what's our accumulated depreciation then, thus, at the date of disposal? 8/16/24, 30,000. Okay, so we did the first step. We updated depreciation up to the date of disposal, correct? Any questions thus far? Okay, now let's continue on with the steps in disposing of this asset. Okay? Well, and let's kind of build this journal entry. Okay? All right. Well, what was the next step in disposing of an asset? Take the asset off the books, right? What was the asset's original cost? $100,000. So we are going to credit machine for $100,000. Okay? What's the next step? Look back at your slides. What's the next step after remove the asset from the books? Remove the accumulated depreciation. Accumulated depreciation is a credit balance. Thus, we have to debit it. And how much was the accumulated depreciation? It's right there, right? So we debit accumulated depreciation for $30,000. Correct? Okay. Was there any asset given? Next step. Was there any asset given or received in disposing of this asset? What did we sell it for? We sold it for $60,000. So do we debit or credit cash? Well, cash is increasing. We sold it, right? So we debit cash for $60,000 because that's what we got. Now our final step is to say, does that journal entry balance? Well, does it? Which side needs help? The debit side. How much help does it need? $10,000. Do we debit loss or gain? Give you one more guess. If you have to, if it's light on the debit side, it is a loss. If it's light on the credit side, it's a gain. Okay? So this is actually a loss on disposal. Okay? A loss on disposal. Because we needed help on the debit side, like an expense is a debit balance, isn't it? Does this make sense? Okay, so we debit loss on disposal. Our income statement would thus have loss on disposal subtracted somewhere in it in arriving at net income. Cool? Make sense? So remember, when you do this in your homework, just follow those 5 steps. Follow those 5 steps. And sometimes it will already have been depreciated up to the date of disposal. Make sense? Okay? All right. I know we're throwing a lot at you today. All right. Questions thus far? Okay. Let's look at the slide here. Another way of looking at that last example of why it is a loss is you can analyze what the book value is at the disposal date. The book value is $70,000. And we sold it for how much? $60,000. So since we sold it for less than what its book value is, that's a loss. Okay, it's another way of looking at it. All right. I want to talk a little bit about natural resources and intangibles. This isn't a real hard section in your book, and I'll have you read these last 5 or 6 pages or so of your text. But let's talk a little bit about it. Now, these are long-term fixed assets, but natural resources are something different. They are things like, I always call it more Mother Nature things, like oil field or a coal mine or a gold or silver deposit. Okay? These are things that maybe are mined, okay? Or timberland, okay? Those sort of things are natural resources. And we kind of account for these pretty much the same way as we would a truck or a bulldozer or anything, but there's just some minor differences, okay? First of all, the main thing is we do not use the word depreciation when we're talking about natural resources. We use the word depletion in its place. Thus, there's not depreciation expense for natural resources, there's depletion expense. There's not accumulated depreciation for natural resources, there's accumulated depletion. Okay? That's really the only difference. What this slide is telling us is that we use a units of production methodology to deplete natural resources. And this is something that you've already been tested over. And the only difference is we're using the word depletion instead of depreciation. Let's take a look at this. We figure out the depletion per unit, which equals your cost minus your salvage value over the total units of capacity. And then we take that times the units extracted and sold in the period. Now this is best illustrated with an example, so let's look at one. Apex Mining acquired a tract of land containing ore deposits. Okay, stop. Somebody might say, well, Dave, you said we don't depreciate land. Well, that is true. If it's just land and it's just sitting there, we do not depreciate it. But that is different from this situation. This is a piece of land that has ore deposits, and we're going to be extracting ore from it. In that sort of situations, well, we still don't depreciate it, but we deplete it. Okay? So we acquire a tract of land that contains ore deposits. Total costs of acquisition and development were $1 million, and we estimate that the land contains a total of 40,000 tons of ore. Now, during the first year of operations, we extract 13,000 tons of ore. Well, let's figure out the journal entry to record depletion. Well, there's zero salvage value on this, so we take $1 million cost minus the zero salvage value divided by the total amount of ore that's in that thing as an estimate. 1 million minus 0 divided by 40,000 tons means we are going to deplete $25 for every ton ton that's extracted in a year. Well, in this first year, we extracted 13,000 units, or 13,000 tons, actually. Probably should say tons. We deplete $25 per ton. Thus, our entry will be in that first year for $325,000 of depletion. Let's see if they make the entry. Oh, they didn't do that. Let me go ahead and write down what that entry thus would look like. Okay? That entry would thus look like, how come this won't switch? Oh, there we go. Okay. The entry would look like this for that example we just did. Not depreciation expense, but depletion expense. How much was it? 325,000. And then accumulated, not depreciation, but accumulated depletion for $325,000. Okay? That's what that entry would look like. Okay? And of course, there might be plant assets that we have to extract these natural resources, and we will depreciate those. Those aren't natural resources themselves. Those are still fixed assets, okay? I'm going to have you read about intangible assets. It's real easy stuff, okay? But let me go ahead and give you your homework assignment, okay? It's going to seem like a lot, but some of these are pretty quick, okay? You'll zoom through these quicker than you think, okay? Let's see if you can read those. Let me zoom in a little bit. Can you see those back there, Lauren? Yeah. All right. I want you to do quick studies 10.5, 10.7, 10.9, and 10.10. Exercises 10.9, 10.16, 10.19, and 10.22. You also need to read those last 5 pages we've covered in your textbook, page 406 through 411. Okay? So that is your homework assignment for next time. We will probably start chapter 11 in the next lecture. All right? All right, we shall see you guys later. Make sure you do your homework, okay? Make sure you do your homework. We'll see you later.